This range is young man wins. All right. We are live. Let's turn Toby off. All right. Welcome. I believe we're live. Let's just check. Kyle, welcome. Happy Friday. I think this is your first YouTube live stream, if I'm not mistaken.
It is. Yeah. It's been a long time coming.
Yeah, man. We just decided to do it like 5 minutes ago. So why not? Usually we record these. We're like, screw it. Let's do it live, right?
Yep. Yeah. Can't hurt.
All right. Good. Hey, everyone, meet Kyle. If you haven't officially said hi to him yet, he joined the team. How long ago now, Kyle?
It's like a year is 14 months.
Yeah,
we'll call it
14 months. Yeah. Kyle's based in Austin. He's running the financial plans, which is a key part of everything we're doing at Inside Edge. And he brings a lot of good experience. He's got family history in our little niche of trading and investing. And he's doing an amazing job. Clients of Inside Edge, you certainly have spoken to him. And you're doing a great job, man. Welcome.
Yeah. It's been fun getting on board and getting to know everyone and meet everyone. So yeah, it's been a good time.
Good. Awesome. All right, let's jump in and let me just get the live stream up. There we go. And there's us. All right. Happy Friday. What a day in the markets. It's been crazy. So let me see here. I'm going to just get rolling here. We're going to do a quick update. This is, for everybody. We sort of split the videos up where we'll focus on market related content. And then when we speak specifically to investors, we make that a private video. But everything we have this week, we're gonna be able to share with everyone. So, any opening comments before we dive in, dude?
A really strong week, all-time highs. It's interesting market.
Yep, it really is.
Lots to talk about. Yeah,
lots to talk about for sure. It was a good week. I'm floored, just not floored. Beat long, really good week, but intense. So let's go in. Here are the disclosures. Typical. Have a read through if you have any questions there, and we can certainly email you any policies or anything you have questions about. So, we're gonna sort of jump in here a little bit. I'm active on social, obviously. This is one of the I think coolest responses to a tweet that I really ever got, and I've referred to it a couple times, and it speaks to the conversation that's happening out there in social media and traditional media and this age of quick gratification, headline clicking, where anybody whose business is to generate click and traffic on whatever page or post they put on, so they up their ad dollars. It's tending to be a very headline driven market, and generally the negative side of a story is what drives clicks. And it's turning into this, especially in this bull market, which I think is one of the most hated bull markets of all time. He responded to something. He said, "I love no matter the market. This is always a reaction from the faceless crowd. Bulls get no respect. They're reckless, lazy, out of touch with reality and the facts. On the other hand, bears are hailed as prudent, responsible, careful, and scholarly." I thought that was so true. So it's part of the reason that I think we're seeing such an amazing ramp right now, because there are a lot of fundamental and theoretical stories that do sound good, that have nice headlines, that generally look at the negative side of the market and cause people to either exit stocks or prefer more allocation to 4 or 5% short-term CDs rather than being in the stock market. But that realization, we think, is starting to come off, and that's why people are starting to kind of do this. So I don't know. I just thought it was kind of a fun way to open up. But again, Kyle, jump in if anything hits home here for you. Earnings, just a quick look of what we just saw for the week. It was a very we had a lot of earnings from various kinds of industries and stocks, and one that I want to focus on is Spotify. I did something on CNBC talking about that, and we hold that in the portfolio, so I'm going to talk about that one. Lilly, we also hold that one. I mean, that one's just absolutely crushing it. But there's a lot of consumer-facing stocks, and we'll talk about that a little bit. Not so much of a tech-driven market for earnings. Another one that we're going to be watching that is, I think, a big AI play, especially as AR and VR become more a part of our everyday lives. And certainly this one's part of my kids' lives is Roblox. So that's one we'll be watching. Seasonality, for February, you look at the average return of the major indexes in the macro markets over the last, say, 40 years on various timeframes between the Nasdaq, the S&P. The seasonality, this is a weak month. In fact, in February, it's the second weakest month for the Nasdaq going back to 1991. It's not a hugely negative month, but it is, in fact, the second weakest month. And the S&P is the same way. So February is the second weakest month. September is the weakest month on average, right? And the S&P is going back 74 years. So far, we're not halfway through yet, but this diamond is where the S&P and Nasdaq are right now, where seasonally they're very negative. The treasury market. Okay, so this is the price of treasuries, and every time you hear the 10-year yield quoted, and they quote it usually in yields in the media, this is the opposite. This is the actual price of the bond, the yield and bond trade opposite. So traditionally, 10-year treasuries are down the second most of the year in February. So again, treasuries down, that means yields up. And as we've been talking about in this video, generally yields up is pressuring the stock market. So you can see where the diamond is. The 10-year bonds are down 1.4% this month. That means the yields are up, and the stock market's doing quite well. Related to that, the dollar, generally what happens is if the U.S. dollar is strong, stock market comes under pressure. It's kind of a complex relationship we can talk about, but these two are related. As our interest rates go up, our investments, whether it's real estate or equity or fixed income, become more attractive from overseas investors. So they sell international currencies to buy dollar to buy our investments. So that's the relationship. If the treasury market's down, yields up, that means more money can be made in the U.S. So money flows into the dollar. Okay, that's the relationship. Traditionally, it's a strong month in crude, and in February, it's also a good third, fourth best month for gold. So, I would say generally it's not a good month seasonally in February, everything pulling it together, but the market so far is acting quite well. Did you know, Kyle, that the MSCI, this is the All World Stock Index, hit a new all-time high? This is all major markets combined into one. We are at new all-time highs in global stock markets.
Yeah, it's a nice stat. I saw it in another video, so I didn't know that. But
okay.
It's a good one.
That's pretty awesome. And this is including a big one that we'll talk about, which is China. So here's the S&P. We hit a very, very key psychologically important level, which is 5,000 in the S&P 500. We came close to it here in late 21. We know what happened in 21, 22. We'll look at, I think, a better look at this on the Nasdaq and see how significant of a bear market this is. And I want to take a second to reflect on this, Kyle. But big drop in 22, came back. We know the July to August sell-off at the end of last year. And then this has been 2024 as we're ripping up above these old highs. So there's the S&P. For you technical types out there, I just want to talk about the Nasdaq. Now, this is the Nasdaq 100. Okay, it's about 50% technology stocks, but it does have other sectors in there as well. And I think I'm hearing a lot of people, again, this is a hated bull market. They're saying, well, this has come too far too fast. And I said, okay, well, let's look at the last few most significant advances we've seen in the Nasdaq. And if you look at the drop from 2000, okay, there was the tech crash of 2000. Here was the low. How far was this advance? Well, from the low up to heading into the housing crisis, the global financial crisis, the market advanced 181.5%. There was the GFC, and then we embarked on the next run, which, you know, again, a lot of QE, which is quantitative easing, bond buying, suppressing of interest rates. There's a lot of reasons, fine. But the fact remains that this rally with this COVID short-term recession went 1,545%. So we have 181%. We have 1,545%. This guy right here from the recent lows has gone 68%. So if you kind of square that up, you know, the advances when we go on these bull market runs, we're very, very immature, I would say, in this. And to say just because we moved above recent highs, it's overdone. It's important to look at the power that's behind this Nasdaq and the length and the duration of rallies that have happened in the past. And, you know, there's still, Kyle, what was the stat we did either last week or 2 weeks ago? I mean, how many people still believe we're headed for a recession this year?
Yeah, so 62% of people right now
still expecting a recession.
We're in recession, yeah. Higher than 2007. So
right.
Yeah, by a lot. So it's shows how, you know, where people are and where inflation is kind of taken things. And yeah, it's surprising that we haven't, given the sentiment.
Yeah. And you know, we've also looked at money on the sidelines. You know, we've looked at that figure as to how much money is in money markets. And in Q4 of last year, it made a new high at $6 trillion. I can't wait to see if we drew down or not, but there's a lot of money that is going into money markets because of that fear. 2/3 of respondents to these surveys we look at are expecting recession. That money is going into CDs and 6-month treasuries and cash. And, you know, you look at it in paper, 5% yield is nice, but when you factor in inflation, you're making 2%, then you pay tax on that. Like, and then you watch Nvidia going up 10% a month, and you're like, maybe that wasn't the right. So wonder if that money is gonna start to come out. I can't wait to see where those money market funds go. So, you know, it's still very hated. People are expecting recession. Even Carl, you know, we even took some very friendly, unprofessional shots at some very prominent hedge fund guys who are selling fear, and we kind of poked through it a little bit, and they're pounding the table for recession, and we may get one. You know, you can go back and review prior videos at that, but even the pros, some pros are big time guys are pounding the table for recession. So if that story were to not come off, there is a lot of caution that is going to result in buying at higher prices that I think may continue to catapult this higher. Here's Nvidia. I just wanted to show you the chart. This is captured. This is hot off the press today. This is going back from 2017. So you're talking about 7-8 years. You know, Nvidia. You know, and here's the other thing. People say, well, okay, the market's overdone, and Nvidia's gone too far, too fast. Kind of continue on the conversation from before. Nvidia just went like less than 2 years ago. Nvidia just went from 370 to 110. It already crashed. Yeah, I mean, it's up a lot, but Nvidia went, I don't have the exact numbers, 370 to 110. Like, it dropped, whatever that is, 60-something%. It already crashed. Right? So we just broke through these highs at 300. We stayed below 500 for a while, and this most recent move is huge. It will be corrected at some point, but let's not forget that the market just got clocked. You know, this right here, even though it doesn't look significant in the Nasdaq, you got to keep in mind, Kyle, we launched a wealth management business, and we sat through and we worked, I think, fairly well through the second biggest decline in 22 years.
Right.
Do you realize that?
Almost the whole, yeah, it was back half of of 2022. It's a long time.
In the first quarter of 23, it was, I mean, this
Yeah.
decline was the worst Nasdaq decline since the global financial crisis, coming from the 2002 lows or 3 lows. Like, so don't forget, when people say we're overdone or is this a bubble, dude, we just had the second worst bear market in 2 decades. And now we're just making new highs. So when people say, oh, it's bubble-ish and we're too far ahead of ourselves, this is the natural psychology people go through. And, you know, we're not table pounding bulls. We are active management at Insight Edge. We pride ourselves, and I've set up this business such that our clients know that we are on top of this every day. And if we see signs that we want to go protective, we will let our clients know right away, and we'll make moves to become protective. We will make moves, and we've done it. We've done it. And we showed you, our clients, how we've done it in the past. So we're not table pounding long mandated bulls all the time, but let's keep things in perspective, what we just went through in 22 and first quarter of 23. All right. China. So China's second largest economy is in some trouble here. And this is I don't want to sound completely rose-colored glasses, ignorant to any risks out there. China is a real issue. The officials are stimulating. They just did a trillion yuan bond issuance, which is about $137 billion. They called it a mid-year revision. They have some data coming out that they are in deflation. They have falling prices. January CPI was just released. It's down 0.8% year over year in January, and 0.3% month over month versus December. So, we have falling prices in China, right, where we are combating the opposite, which is inflation. So the way the global economy works, we will, because they're a huge supplier and we buy a lot from China, we will be importing deflation, which is going to help our domestic inflation fighting front, number one. And then there is, as I said, the Chinese officials are in there doing what they can to support the economy. They're taking multiple measures, as I sort of lay out in here. And there was some good news where the economy in China grew 5.2% for 23. Their goal was 5%. Okay, and this was after a 3% growth rate in 2022, where they had to do a lot of COVID lockdowns. So China has really had some issues. Now, this is the Hang Seng. This is the Hong Kong stock market. And, we're looking at this back from 1986. Okay, so this is 86 up. We did sort of a double top up here into 2019, and then since then we've sold off. One thing that we find unfortunate when we look at portfolios, Kyle, is, even with people who we say are younger, 50s is young for us, 40s is really young, 30s is babyish, and I mean that, but to be diversified, especially internationally right now with so much exposure to China, there's a lot of opportunity cost lost there, right? Do you want to say anything about that?
Definitely. I mean, the performance international versus U.S. or China versus U.S. stock market hasn't been very good recently. And with all the geopolitical stuff, you could say the risk hasn't been worth the reward.
No, and there hasn't really been much reward. And you can kind of quantify that. So this green line down here, let me switch over. The green line down here is taking the Hang Seng, which is the Hong Kong stock market, and dividing it into the S&P. If that green line is dropping, that means Hong Kong is underperforming the S&P. So we did see outperformance of China to the U.S. from 98 into 2007. But since then, it's been all downhill. So from 2010 to now 14 years, Hang Seng has been underperforming the S&P. So, if you have diversification in emerging markets, there's a very good chance 30 to 40% of that emerging market fund will have Chinese exposure, which has been underperforming the U.S. for 14 years. And we're not opposed to getting Chinese exposure. And there might be a time where we might be holding some support levels here, and it may be time to go. But I'm kind of jokingly say you should be diversified and hold international equities in your portfolio. Just make sure they're holding support levels. Make sure they're not in a crazy downtrend. This is Shanghai. So we're going from Hong Kong to mainland China. This guy's been underperforming the market since 2007. And you can see it's kind of riding this uptrend here in Shanghai, and really better hold it. And from a technical point of view, if you don't hold this sort of line of support, it could be problematic, especially as the Chinese officials are doing what they can to stimulate the economy. So we do have to watch that. That's a risk. Okay, talk about diversification, sir.
Yeah. So this chart has always interested me. It's called a Callan chart and serves as a nice tool to kind of, I guess, understand the cyclical nature of different asset classes, the importance of diversification, the kind of the historical volatility, just looking. I mean, you can pick any asset class and look and see. The real estate interests me. You can see at the top, best performers year to year, at the bottom, the worst. And so, I mean, pick any asset class and just, you can see kind of how it's done over the years. And with real estate, being either top or bottom and probably half the years, and then kind of middle in the others. But you can see emerging market kind of doing the same thing. It's either boom or bust in a lot of the years. So just a nice.
That's interesting. That's
nice interesting chart.
2017 was 37% in emerging market. That's interesting. Huh. Have to look at that. Small caps led it in 16. I actually was talking about this. And then I know there was a lot of underperformance with small caps in 17 and 18 because the Fed started raising rates. Large cap, then we went into, so small cap led it in 20. Interesting. Okay. Large cap, cash in 22. That makes sense. Real estate down 20.
The only positive asset class in 22
was cash. Well, that's interesting. Okay. Good stuff. All right. So just kind of a shifting gears here quickly as we're moving along, just looking at earnings. This is the breakdown of market capitalization of what we saw this week. It was pretty diversified in terms of earnings coming out: healthcare, industrials, consumer discretionary, financials. And then tech was way down here. So not a big week for tech. So that's fine. Okay. So let's talk about this quickly. The big news that I thought was headline grabbing was this credit card delinquencies. And this was really the first part of this week. Again, headlines are meant to grab your attention, and your attention is not usually grabbed by, bullish or encouraging headlines. And, all my friends at CNBC, I've been working with CNBC for a long time, not picking on them. It's just the nature of the consumer. People are gravitated towards catchy headlines. You're like, a little bit on the fearful side. So credit card delinquency surge in 23, indicating financial stress. The New York Fed says, right? So let's pull this back over. That's the headline. Just reading the CNBC article at Touch, delinquency surged more than 50% in 2023 as consumer debt swelled to $17.5 trillion, said the New York Federal Reserve. Debt that's transitioned into serious delinquency, or 90 days or more past due, increased across multiple categories, but none more so than credit cards. With a total of $1 trillion in debt, credit cards moved in serious delinquency amounted to 6.4% in Q4, a 60% jump over 4%. Okay, so I know there's a lot going on there. So on the headline, all right, it's scary. Maybe that's a reason I want to stay in money markets or stay in defensive positions, not move in the market. Well, all right, well, let's kind of look behind this a little bit. Household debt reaches $17.5 trillion in Q4. All right, delinquency rates rise. This is from the New York Fed. Total debt is $17.4. This is housing debt, right? Which we know, and we've shown on videos before, that mortgage payments as a percent of disposable income for consumers is rock bottom, because people aren't getting rid of their 2.5%, 3%, 3.5%, 4% mortgages. They're just not, and wages are going up. So this is non-housing debt, and this is what they're talking about right here. So okay, let's jump into that a little bit. So we're looking at 4 different stats here. This is from the St. Louis Fed. Green is mortgage debt as a percent of disposable income, right in the lows. Red is your consumer debt as a percent of your income, which is right here. This is the one they're talking about. This blue one up here is household debt. That is a sum of consumer plus mortgage. So consumer is obviously credit card and stuff like that. Mortgage is mortgage. Household debt, that's the sum. And then this purple one includes, I think, home equity loans and a few other debts and stuff like that. But the one they're focusing on is right here. This is the one that they're saying consumer debt and delinquencies are seriously increasing. This is the increase they're talking about. Right. And I think we can see that it's rolling at about 5%. And you can see in 90s, we're at 5, heading all the way up into 2000. We got up to 6 or 7% looking at this scale. We dropped down after the GFC. We're low after COVID. And now here we are. The delinquencies they talk about. Here's another chart from the New York Fed. Student loan delinquencies, mortgage, auto loan, home equity revolving. This blue one is the credit card delinquency. This is what we're talking about. Credit card delinquency surged in 23, indicating financial stress. They surged more than 50% in 23. This is what they're talking about right here. That we have been a lot higher in terms of 90-day plus delinquency in credit cards. And I would say this is sort of a range bound for now instrument. Okay, now there's also more to this story. If you look at that household debt service payment, okay, that's the same stat as this blue one right here. Household debt service payment, now it's red, on top of real GDP. What do you see here? I see a correlation. I say the bigger the economy and the more money and value we're collectively generating, it is accompanied with higher household debt. The more productive we are and the higher the salaries are going, the more people are leveraging up and buying things on debt. But again, you look at the percent change on household debt correlated to GDP, like I think, Kyle, from where I sit, I want real GDP to go up, which probably is going to drive household debt up, which I think drives equity prices up. And there will have to be a resetting at some point on that. But from where I stand on this chart, like I think the two should go up. And if you look at the year-over-year change in the red, like we're not anywhere near concerning levels. Right. And again, like,
yeah, I think as long as it's going up, then or GDP's going up, then you can count on the debt to go up.
Right.
And like you said, yeah, there's going to be a ripple effect from that, including more of that debt going into investments and allowing people to invest more and drive prices higher.
Right. So, yeah, and again, I mean, listen, if the 90-day delinquencies continue to spike 10, 11, 12, 13%, okay, then we'll talk. But it's a slight bump up. And I was looking inside of the credit scores of all these different categories. It's the lower, like 600, 500 FICO scores that are doing it. And, the 600, 700, 800 FICO scores, they're not in the delinquency category. So, I think there's some lower quality borrowers who are driving this higher, but I think on the whole, higher quality, higher FICO score buyers, I think we do want to see them take on a little bit more debt as GDP goes up, and I think that would propel the market forward. So, kind of related to that, I wrote an article for CNBC this week on a holding of ours, which is Spotify. And this is a fun It's a communication stock, but I think it's very much tied into the health of the economy related to the last conversation we had. And what I was doing is making the point that, with Spotify, they came out with earnings, they crushed it. And I was thinking back to two other earnings reports, two stocks that we hold in the portfolio that had similar stories, which is subscriber growth on their streaming subscription services. Not only that, Kyle, but also advertising revenue on those subscriptions that showed pretty significant growth. Spotify did, Netflix did, and Amazon did. And to dig into this a little bit, this is what I wrote for CNBC. Figures investors most focused on the earnings were premium subscribers added and advertising revenue. Analysts are expecting 8.9 new subs. They added 10 to bring total paying user base to 236 million. Spotify is ramping up to get more ad tier services, and there's interest for companies to buy advertising as Spotify is coming online. Plus, they just signed Joe Rogan for another 250 million. So this is a leading indicator. Netflix is already reporting it, right? And we hold 2% allocation in tactical alpha growth in Spotify. Netflix, we hold 3%. Netflix exceeded analysts' expected subscriber growth. On the 19th, the CFO said they would not focus on advertising revenue if it couldn't be a meaningful portion of our business. So Netflix is moving to the point where advertising is going to be an increasingly large part of their business. Amazon, same deal. That's a 5.5% holding in TAG. Prime memberships, advertising sales in the new premium Prime Video tiers exceeded. The growth rate on advertising revenues expected at 26 came in actually 1% higher at 27. I know that from memory. The advertising revenue on Prime Video is growing faster than their cloud service, Amazon Web Service at 12%. The point of all this is Spotify is already monetizing with advertising tiers, but they're going to do more. Netflix is moving into it to ramp up percent of advertising as their subscriber growth is growing. Again, Spotify subs are growing. Amazon Prime is looking to monetize even more subscribers and advertising to their Prime Video. The point of all this is if the consumer was viewed to be on shaky ground, these companies would not be moving towards a platform where they can sell advertising, and companies are going to come in and buy advertising those platforms. They wouldn't make that investment if they thought the consumer was in tough shape. So in all three of these stocks responded extremely well to earnings, and it was because of that. It wasn't cloud, that's been driving Amazon forever. Is more Netflix on the advertising as well. So I thought that was really telling with the consumer. Anything you want to jump in on that one?
I think it just confirms the consumer health right now. We've looked at some surveys. We brought up the concern about debt. And then you show the ratio against real income, and it kind of makes you think that as long as unemployment stays as low as it is, which is as low as ever, then that shouldn't really be a near-term concern. But I mean, it's still going up. I think it's a concern, but not a near-term market concern.
Yep. Gotcha. Well said. All right. Let's talk a little macro. So a couple forces internationally, shifting gears off the consumer into global macro. As we mentioned, rates, the market's going through this realization. That's one of the biggest concerns that we have, that the Fed's not going to cut 6 times. It's going to leave rates where it is. The concern that we have is this realization process that the market's going through, that we're not going to get 5 or 6 cuts this year unless something significant happens, and the Fed has to slash rates. So the market's going through that realization process, and interest rates are sort of staying pat right now. The 10-year Treasury yield, which dictates the 30-year fixed mortgage and credit card loans and auto loans and stuff like that. That's the heartbeat of America on interest rates. Well, it's getting stubborn around the 4%, which I think is fine. The dollar is responding to that. And again, the higher the interest rate here in the U.S., the more international capital flows will come to us, strengthen the dollar. Generally, the stronger the dollar, the lower our stock market, because we have such big multinational corporations that make money overseas. They got to bring money back, realize it in dollars. If the dollar's stronger, they're going to bring back less profits. So that's if you remember back to the economics. So that's why the yield and the U.S. dollar are showing an inverse relationship generally to the S&P. Well, they're both moving up, but we are starting to see a little bit of a ceiling in both the dollar and yields. And if we can sort of cap that off as, again, the market's coming through this realization that yields aren't going to drop because the Fed's dropping rates, then if that can kind of calm down a little bit, then the market should be able to continue higher. Showing you sort of some of the gory details here. The dollar, we're
Hey,
watching.
Todd, make sure you're showing the chart.
Thank you very much. I have it.
Yeah.
I need the shock collar. Yeah, here's the chart I was just showing you, the S&P and yields in the dollar. Thank you very much. So dollar green, yields in purple, and then the S&P in blue and white. You can see the clear inverse relationship. So there's the dollar into resistance. This is a little bit of the technical gory stuff we do. And so far it is holding that resistance level. So if the dollar can continue lower, that would be a good thing. The big one we're watching is also crude. There's a couple different ways to look at crude. I won't go into it too much here, but crude's been quiet. And I think the direction of where crude goes will be telling. If it breaks through 70, we want to see where interest rates go in the dollar and stocks. Our guy, Terry Long, who works for us on the research business, he had a long career with ExxonMobil, and he was an economist and a systems guy there. So he very well knows. And he's saying we're very well supplied with oil right now. And barring Iran getting involved in sort of blocking the shipping lanes, barring that, he said we're well supplied. And he kind of thinks crude should move lower, which means interest rates move lower, which probably means the dollar means lower, which probably means the stock market goes up. So that's kind of how those four major asset classes trade together. It's changing quite a bit, but they can give you a good tell and color as to what's going on in the global macro space. This is a little wonky for this, but a long time ago, my last real job, I traded for a hedge fund on Wall Street during the global financial crisis, and I was trading for a foreign exchange firm, FX hedge fund, and a retail brokerage. So the dollar, it's not just like a dollar. The dollar doesn't just go up and down like the stock market. The dollar will have different, experiences against different currencies. And if the dollar is rallying, which I said generally is bad for the stock market, well, it depends on against which currency the dollar is rallying. If it's rallying against the Australian dollar, which has close proximity to China, or the New Zealand or the Norwegian currency, those are all considered commodity currencies, and they're correlated to generally global growth. The dollar is more rallying against the Japanese yen. And a super long story short, we're seeing the most strength in the dollar against the yen. That is a good risk-on signal. Long story short, if you ever heard the carry trade, back in 2007, the real volatility in the housing crisis was not really in the stock market, it was in the FX market. For years, what had happened, because Japan has persistently low interest rates, global wealth managers would borrow money in Japan at very low rates, 0.5%, 1%, take that money, invest in overseas bonds in Australia or US at 5%, pay a half, invest at 5%, make the difference, everything's great. That's called the carry trade. That's fine, provided global market volatility stays low. Well, the housing crisis came about in the U.S. and that spiked volatility, and the carry trade had to come off. The point is, there is a lot of selling in the yen. People are starting to put that trade on, and they wouldn't do that if they didn't think sort of the coast is clear for a while, where they going to have markets that are somewhat calm and taking money out of Japan and investing overseas. So you're seeing yen. The yen pairs move up. So dollars moving up against the yen, euros moving up against the yen, Aussie starting to move up against the yen. So it's not really a dollar move. It's more of a yen selling move. And again, that's a global macro risk on. So I know that's over the head of a lot of domestic investors, but it's all the stuff you need to look at to get a big picture. One more little wonky macro chart. I really Dow and gold, gold is a market where you want to see it go up, and it doesn't make sense. But right now, the way everything's trading, if gold goes up, that probably means U.S. interest rates are dropping and the U.S. dollar is dropping. We want gold to go up. Gold in the stock market right now, believe it or not, are trading with a positive correlation. So we want to use gold up to 2,100 as a confirming indicator that stocks should go higher. A lot of people think gold acts as a defensive play, but right now, and for quite some time, it's been that gold and the stock market are trading together. Here's the kicker, Kyle. We want the stocks to go up at a faster rate than gold. We want gold to go up, but we want stocks to go up at a greater rate. And that would take the Dow gold ratio. So you take Dow, divide it in the price of gold. If this guy starts to move up, that's a good thing. If we can get gold above 2,100 and we can get stocks continue to go with Dow gold going up, that is another very good macro risk on, which around the globe, the coast is somewhat clear. So sort of topping it off, uranium, it's a holding of ours. I think with the Ukrainian-Russian situation, countries are reminded how important energy independence is. And there's been a big move back into nuclear and uranium post-Fukushima in 2011 and 12. Uranium's a holding of ours. So things seem to be moving around. Cameco just reported earnings and just missed, which is a major uranium player, but we're still going to be keeping an eye on that. So that's just a quick update from where we sit, but just summing it up, and then I'll stop talking. Really amazing, I think, a historic week up through S&P 5,000. Nvidia was just on fire. Chips, semis are huge as they're being integrated, and I think they're going to change the way we interact socially and professionally, and I think now that we have sort of a macro situations under control with the Fed, and people are realizing that perhaps we may not be going into a recession, I feel like money's going to continue to come into this market. So super interesting. I'm encouraged, Kyle, and that's all I have.
Yeah. Some major innovation, some American exceptionalism going on, and
well said.
lots of economic kind of backstops. You have rates that are high. If prices get shaky, like those rates are going to go down.
It's a good point. And people are saying the Fed put is back. I don't know. I mean, you're younger than I, but do you remember the Fed put? Like, if things get shaky, the Fed's got plenty of elevation now to adjust rates down. And who knows? The world's crazy enough where they could be buying bonds again with quantitative easing. Who knows? So I think that's a good point.
Yeah, exactly. Yeah. If things go the other way, China's outbuying as much bonds, just like we would be if we were in their shoes. So,
right. Good point. Yep. I think at the end of this year, I'll go out on a limb and say the market is so focused on how many times the Fed's going to cut rates. I wonder if we live in a world at the end of 2024 where the markets are saying, well, thank goodness the Fed isn't going to raise rates.
Yeah. There's still a lot of money floating around that's on the sidelines, and I mean, people are still, they're still getting their paychecks and investing in their 401k and their S&P index, and don't see any slowdown there. So
no. It's fun. Well, that's who we are. We are Inside Edge Capital, and we've been working on this for a long time, where I think we're a very good blend of active portfolio management for the everyday, not sophisticated investor. We work with sophisticated investors, but the everyday interested investor who wants to work with someone who takes great care on the management of the portfolios as well as management of your. How do you define it, Kyle, of their personal and their family financial life? How would you sum it up?
Yeah, just managing everything holistically. I mean, your investments, your financial plan. I mean, looking at what your goals are, what your risk is, making sure you have a plan that you can look at and update and progress towards. And we're retail. We work with people. individuals and their families, and we're just trying to get a group together and grow some wealth together and do things the right way and do things from a risk managed perspective all the time. And yeah, it's pretty much who we are.
Yeah. And it's really important. I think when I set out to launch this, I could launch it, without financial planning and just run managed accounts. But, Kyle, in order for me to have confidence to trade the portfolios as the way the market dictates it, I really have to count on somebody who is watching that each client is properly allocated and they have right equity, fixed income allocation. They have, retirement money or not retirement money in the right portfolios so that, I can do what I do and you're keeping an eye on things outside, though you do help me obviously with the markets, but it's such a key part, I think, with active management. I mean, if we're just putting people in S&P index funds and just letting it go, like, okay, there's not much to do. But if we're, if we're trying to really fine tune and save every 1 to 2 to 3% we can at significant market turns, or get protective, like a good financial plan and working closely with somebody who knows your situation is really important, I think, for the client, Kyle, but also for me to know that that's taken care of.
Yeah.
I hope that makes sense.
It allows us to execute our strategy.
Yeah.
And that's just part of the tangible value. I mean, you get into tax efficiency and so many other ways where it's just like, hey, did you know you can do this? And then now you have a nice strategy that might be able to save you some money or make you able to go further, and that's the other part too. So and then the intangible value, like it's nice having a plan. It's nice having something, like peace of mind knowing your investments are working together with a plan that you have in hand that you can look at and go back and review and update and all that.
And I'm watching as the clients, you're meeting all my clients, like, I think they like you a lot more than they like me. I mean, you talk to them a lot. I mean, no. So I get a lot of nice texts. I really do from clients like, "Hey, he's good." So no, it's a super important thing. So we'll put a wrap on that. So any final words? I was going to go off topic.
No, go off topic. I hope y'all. Thanks for watching, and hope y'all have a great weekend. And that's all I got.
Nice, man. So, all right, we're off the record, but we're on the record now. So I'm going to a 40th birthday, and I don't think he's watching. You're a golf guy, so you like this. So we're all members of the club here at Saratoga, and in Saratoga, Goldman Sachs has a huge private wealth management arm. Like, I think one of two biggest for private wealth management here, way upstate New York. These guys, I've got like 12, 15 of these guys. They all literally work for Goldman Sachs in like upstate New York in Saratoga. It's crazy. It's really funny. So these guys run, wealth management for CEOs, basically, C-level suites, like the crazy story. But anyways, we're going to a surprise party tonight, and I'm sure he's not listening. I'm sure it won't get back to him. I'm sure he's not listening. But so he's turning 40. So what I got him, Kyle, is his name is, let's call him Adam. I got Titleist balls, all with the number 40, and I wrote on it, like, he's a somewhat high handicapper. I said, when this ball is found, please return to let's call it Adam Smith. Like whatever, just try to I almost thought about, because he works for, I thought about putting Inside Edge on the logo on the ball, put his name on it, like, when found, return to him in number 40. I thought that was
that is good.
Yeah.
And now, if y'all are at the same club, now you can find them all over the course.
Exactly.
Over the next few months.
Title's turned it around real quick. I mean, I think Trish ordered them for me. I think they were here in like 4 or 5 days. It was pretty funny. So I thought you got a kick out of it. So.
Oh yeah.
All right, dude. Have a good weekend. Hang in. I'll talk to you.
Yeah, you too.
Thanks everyone for hanging out, and check us out at Inside Edge Capital. And obviously, as you know, I'm running 2 businesses, Trading Analysis, which is the research arm. Inside Edge is the wealth management, and in 24, these two are gonna start to do this. We got big plans, so wait to see what happens. It's really fun.
For sure.
All right. See you guys. Have a good